Hey Ray, how's it going? Okay, great. So listen, I was just about to do a video on, maybe your portfolio, and I was just thinking, just because we both grew up on Long Island, I was wondering if you could give me, some pointers on your portfolio, what's going on. Hello? Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money. Please do not forget to subscribe. So in this video, you heard it, that we're going over Ray Dalio's portfolio. So if you don't know who this guy, Ray Dalio, is, he is the largest hedge fund manager in the world, managing billions. Last year in 2018, he returned over a 14% return when the market was actually negative, and average hedge fund returns for that year, last year, was negative 2%. Now, if you wanted to invest in this guy, unfortunately, he closed the fund before that. You would need at least $100 million just to talk to the guy. Now you can't even talk to him. But he is being more open because recently he did speak to Tony Robbins in his last couple books. I'm reading Unshakable right now, and I'll probably do a review of that book in the future if you guys are interested. But in one of his books, he did go into Ray Dalio's idea of an all-weather portfolio, which we'll be going over later after the holdings into his portfolio. So of course, with Ray Dalio, there's Warren Buffett and all those guys out there as well. So they're all very skilled investors, and you would think they would take a lot more risk because they're getting more return. On the contrary, they actually don't. One of the main things that they focus on, or at least Ray does, is asset allocation. They diversify their portfolio. So of course, going more into this stuff throughout the video, we'll do that. But if you want to learn more into these financial masters' heads, you could definitely check out Tony Robbins' books. I'll leave a link in the description if you want to check those out. So anyway, for right now, let's just go over the top 10 holdings of Ray Dalio's fund, Bridgewater Associates, right now. So the first top holdings, now this holdings was around like February 2019 anyway, so it might have changed a little bit. However, the top one was the S&P 500 ETF, Spiders. So you could see their yield year to date is over 17%, has had some hiccups, but overall is doing very well. You could see we're still kind of in a bull market. Now I'm just going to give you these holdings from the top holdings down. So the second highest holdings right now is Vanguard FTSE Emerging Markets Index Fund ETF, VWO. You could see their year-to-date return is over 15% right now, and the yield is around 2.5%. The third holdings in Ray's portfolio is iShares Core. The third holdings in Ray's portfolio is something similar. iShares Emerging Market ETF, IEMG. You can see their year-to-date return is over 12.5% with a yield of 2.5%. The next holdings, which might actually surprise some people because a lot of people do not like gold. He does have gold shares, GLD. Their return for the year is actually a little bit negative, and it has no yield. Next holdings, going back to emerging markets, iShares ETF. We can see their year-to-date is just over 13.5%. Next, we're getting into some bonds. So now we're looking at iShares iBoxx and Investment Grade Corporate Bond ETF, LQD. Their year-to-date is 6% with a yield of 3.5%. Flip-flopping back into the normal stock market of S&P 500 ETF. Again, very similar to the first one. Over a 16% return, around a 2% yield. Moving back away from stocks into bonds again, iShares 20-plus year Treasury Bond ETF. Their year-to-date is over 1.5 and yield 2.5. Next holdings of corporate bonds, ETF of HYG. Their return of over 8% and a yield of 5%. And last but not least, the 10th holdings of his portfolio is iShares JP Morgan USD Emerging Markets Bond ETF, EMB. Year to date over 7% and yield 5.5%. So this is actually very interesting because you could notice basically two main things. The first one is he loves ETFs. Investing into ETFs are great for multiple reasons. One is that it diversifies you everywhere. So instead of trying to choose which stock you want to really get into, you could choose them all. Like, for example, the S&P 500, you're choosing 500 of the largest companies. So he uses a bunch of ETFs. But at the same time, he also doesn't only diversify through ETFs, but also diversifies across multiple asset classes. Like we saw throughout the holdings, of course, he has the S&P 500, so in American companies. He has emerging markets, so in other companies throughout the world. So, for example, if America doesn't do so hot, another country might do that. Now, aside from stocks, he is also invested in bonds. Multiple different kinds of bonds. He's investing in corporate bonds, which are great because they give you a little bit more yield than a normal treasury, but at the same time they are kind of safe because they are larger companies. They're giving you like it was 3% or so. At the same time, he was investing in long-term treasuries. One example was 20 plus years. And he was also investing in some high yield corporate bonds. Now, those are a little bit more risky because high yield means more risk, but that also gives you more of a return. So he's balancing the risk there. He's investing treasuries, but at the same time, a little bit more riskier companies. Another way to diversify emerging market bonds. They're giving, this was over a 5.5%. And it's actually really interesting because year to date, they've been returning really good actually, as well as getting that yield. So this is amazing because let's say if stocks didn't do so well, bonds could still do okay. So he really diversifies, which is similar to his all-weather portfolio, which we're going into in a couple minutes. So he really does invest in no matter what the economy is doing, he's making money. And that's actually a very risk-averse thing, that his main focus is to not lose money. And you could also see that diversification into even gold, because history has shown in recessions, in crashes, people flood to gold. That's the safe haven, and gold just skyrockets. Moving into our all-weather portfolio. Stated in Tony Robbins' book, he stated the stats for this strategy, this asset allocation, was 85% of the time in the past. I think it was like 75 years or 100 years or something like that. But with that asset allocation, he gained money 85% of the time if you did this asset allocation. The other percentage lost an average of just under 2%, comparing to like the last stock market crash was like 30 or even 40, pushing 50% drops. And losing money is drastic if you look at Warren Buffett's rules of investing, just because of this idea right here. Let's say you start out with making things easy, $100,000, and you go into a crash. So you lose 50%, now you have $50,000. Now normally you would think you would need a 50% return to get back to even. But a 50% return of $50,000 is $25,000, meaning you would increase to only $75,000. You're still down. So to recover a 50% drop, you actually need a 100% return. That is why losing money is drastically horrible. So drum roll of Ray Dalio's all-weather portfolios asset allocation right here, which is only 30% in stocks, which people would flip out about, 40% on long-term bonds, 15% intermediate term bonds, 7.5% in gold, 7.5% in commodities. So he took this complex portfolio of his and basically gave this simple asset allocation as an all-weather portfolio, no matter what happens in the economy. If the economy is good, the stocks take over. When it's not, the bonds still hold it up from their yields, gold's in there, and even commodities. So when one goes down, others go up. That's why it works so well. Again, 85% of the time it went up, and when it did go down, it was only a couple percentage points. Now the crazy thing is, what he actually stated is, well, a lot of people like to try and beat the market. They try to, trade the stocks, try to swing trade, try to day trade, whatever, and they try to beat the S&P 500. That's the benchmark. Ray Dalio, like the biggest hedge fund manager in the world, even says that you shouldn't even try. That he has like hundreds, it even might be up to like 1,600 employees, but he has a bunch of employees that are trying to beat the market full time, dedicating all their time and effort into trying to do that, and they still are challenged by that. So if you're a normal person going throughout your normal life, doing normal things, not focusing on the market like they are, is it worth it? Even he says that it's not. So in trying to instead of trying to beat it, you should index like he does with ETFs and also diversify. Now, of course, do your own research. This isn't like, hey, do this. This is what Ray Dalio has, public information of his portfolio, what he suggests for an asset-led allocation for an all-weather portfolio, and that's really up to you if you would decide to follow that. So with great power comes great responsibility. So thank you so much for watching, guys. If you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. What's your asset allocation? I'd definitely be interested to hear what you have to say. And if you guys are interested in that book review that I'll probably be doing in the near future, definitely let me know if you'd be interested about that. So again, thank you so much for watching, guys, and I'll see you in the next one.